Welcome back, mindful investors. In this video, I'm going to talk about why I love stock options. And here are the two reasons: the stock options versatility and the market's volatility. There's a saying that with stock options, you can win in any market conditions. A bull market, a bear market, or a sideways market, in any market environment. Because within the stock option playbook, there are many strategies to implement. The simplest of all are the calls and puts, which means you're bullish or bearish on the stock. But for each of these, you can either buy or sell them. So you can buy or sell a call or buy or sell a put. And then there are numerous ways to combine them for different strategies. We'll talk about them in a later video. Now let's look at 3 different examples to show why stock options may be for you. Number 1. Squeezing out more dividends on your dividend stocks. So what does that mean exactly? Let's say if you're a dividend investor and you plan to accumulate Coca-Cola stocks throughout the years and hold them forever. The traditional way is to dollar cost average, and let's say you buy some shares every single month. We can stick to that plan but add some stock option plays to boost the returns. We're going to look at the Coca-Cola chart for the year. It started off the year at about $55. And then it jumped to 60, right back down to 40, and then right now is at 52. If you just held the stock for the whole year, your starting and ending point is approximately the same, which means all you made are the dividends of about 4%. But let's say if you sold some option contracts throughout the way, you would definitely squeeze out more returns. With any stock, there will be dips and spikes. Let's say whenever its stock dipped more than 10%, you sold some put options, like here. And whenever it jumped 10%, you sold some call options, like here. So overall, you may have collected more shares during the way down, but on the way up, you could have offloaded some loose shares which you bought at a lower price. So you capitalize on the gains there. By adding these premium harvesting plays, you can easily boost your returns from 5% to 10%. And who doesn't like some free money, right? Now let's look at NIO for the earnings play last quarter. For the month of November, the stock went from $35 to $50, the run up to the earnings. So that's a 50% run up. And throughout the month, I noticed several events that triggered the spikes. The week before the earnings, we noticed that Lee and Xpeng, which is NIO's competitors, reported earnings. And the stocks jumped up 20-30%. And so did NIO. NIO had spikes here. And then on the Monday before the earnings, Tesla went into S&P 500, which caused a huge spike in the EV sector. Right before the earnings, the hype was at all-time high. And that's when I sold these call options at $70. I sold 100 of them, saying that the stock price wouldn't go above $70 within the next day pretty much. Because the earnings was on November 19th, and it's pretty much saying that it wouldn't jump 40% over the next day. And after the results, NIO dropped 10% and then bounced back up 10%. So overall, it was flat, which means that I didn't hit the $70 ceiling I placed. And therefore, I capitalized on this $2,500. It's not much, but these plays happen over and over again. Stocks tend to overshoot and get oversold every so often. And by observing the market, we can capitalize on these opportunities through selling options. Okay, next example, the home run plays. I talked about the various strategies I use for Palantir in this video. And the gist of a home run play is that a stock option contract represents 100 shares. So for every option contract you buy, there's a huge multiplier effect. It could be 3 times, 5 times, and sometimes even 10 times, depending on several factors. For instance, my long call option that expires 14 months away at $20 has gone up 4 times. But let's say if the expiration wasn't in 2022, but in 2021. This option would be worth $30+, essentially 10xing my money. So there are a lot of factors as to how much leverage it is, but even from a conservative play, it's gone up 4 times when the stock has gone up close to 2.5x. So there was like a 70% leverage on it. But during the peak, when Palantir hit $30, this option was at 18, so my play was 6x already. And that's because of volatility. It pretty much shot up in a straight line. Therefore, the option prices jumped up as well. So at $30, my stock tripled up. But the stock option was at $18, which is 6x my money. And that is a 3x differential. This shows that when we implement stock options, when we're right, we can capitalize big on it, 10x, 5x. But when we're wrong with a stock option, we just lose the principal. So let's say my bet right here was $1,000, it could have gone up to $6,000 if I sold at the top. But on the other hand, if the stock remains under $20 within the next 14 months, then I lose my principal, my $1,000. So there is a risk and reward. Because the name of the game is volatility, and by using stock options, we can capitalize on it using many different strategies. I'll talk more about it in later videos. After hearing my examples, would you consider learning about options? Because there are so many strategies I'm going to talk about over the next couple of videos. Stay tuned. Let me know if you have any questions. I'll be doing stock option videos every single day for the month of December. Thanks again for watching, and I'll see you in the next one.